Hello learners. Hi, how are you all? I hope your examination preparations are going really well. What I thought I'll help you all with in this examination preparation is if I can sum up the entire chapter 2 in 15 to 20 minutes, that would be of great use to you in your exam preparation. With this thought, is this video being made to help you all revise several chapters of CA intermediate syllabus. Starting with one, today we'll be discussing chapter 7, redemption of preference shares. So let's quickly get started with redemption of preference shares. So chapter 7 of our syllabus is redemption of preference shares. This, along with several other units of the chapter like financial statements, cash flow statement, redemption of debentures, as well as managerial remuneration part from the chapter, weighs to 30 to 35% of your entire marks in the examination, as per the weightage given by ICA. However, the past examination trend says that you can expect about 5 to 10 marks from this chapter, and not just that, this part redemption of preference shares will get included in several other topics like your cash flow statement or financial statement or even redemption of debentures. Even in the topics with relation to internal reconstruction, you can have an adjustment coming from redemption of preference shares. So let's get started with redemption of preference shares. Before we jump into how to redeem the preference shares, let's quickly understand what exactly do we mean when we say the word preference share. Preference share is a share with preferential rights. The preferential rights are given at two circumstances. Circumstance number one is at the time of payment of dividend to shareholders. Second circumstance is at the time of repayment of capital to shareholders. So in both of these situations, that is at the time of payment of dividend as well as at the time of repayment of capital, first it will be paid to preference shareholders, and that's when, after which is when you pay to equity shareholders. So in the race to collect dividend and repayment of capital, the first receipt will be by preference shareholders, and after then comes our equity shareholder. I hope you got this part. Next, talking about redemption. What exactly do we mean by redemption? I went on to search on Google as to what do we mean by redemption. The meaning that I found is quite tricky, which says that the action of being saved from evil. This has nothing to do in the kind of context in which we are going to use the word redemption from. We are not doing any evil in the business and we are not stopping that evil by doing redemption. Nothing of that sort. So in the context of this chapter, what exactly do we mean when we use the word redemption is it is opposite of issue of shares. So opposite of issue is nothing but redemption. If I have to help you understand the same with the help of to say a small context, it looks somewhat like this. In the case of issue of shares, the company would collect money from the shareholder and give them the shares. However, in the context of redemption of preference shares, company will collect the share back from the shareholder and company would return the money which was previously collected by the company from the shareholder. So in the case of issue, shareholder pays money and the company gives share. In the case of redemption, shareholder gives the share back to the company and company will return the money. Now, in the case of issue of share, the share capital of the company will increase and the capital of the company will also increase. There is increase in asset followed by increase in liability. However, with regard to redemption of preference share, the share capital of the company will decrease, further leading to reduce in the cash of the company because company is actually paying money to such shareholder. So the share capital will decrease, followed by decrease in the capital cash of the company. I hope you all got this. Now let's see what is it that law has to say about this. What are the provisions of Companies Act with regard to redemption of preference shares? The first and foremost point what the Companies Act says is that there is no possibility of issue of any irredeemable preferences. Long ago when you would have read in class 11, class 12, second PUC, you might have read types of preference shares as redeemable and irredeemable. By far there is no possibility of issue of irredeemable preference shares. Any preference shares issued should be redeemed with the maximum period of 20 years from the date of issue. So all the preference shares issued are redeemable within the period of 20 years from the date of issue. So 20 years is a very key point that you should know. The second important point what you need to note is that the shares that are being redeemed can be either out of the reserves of the company, that is the existing funds, or it can be out of the money that is raised by fresh issue of shares. So as a company, I can use my existing bank and cash balances, that is existing reserves, to pay the preference shareholder redemption, or I can freshly issue shares to somebody else collect the money and use such money to pay to the existing shareholders on redemption, or a combination of both is also allowed. And when the company is going for redemption of preference shares, it needs to note that the shares are fully paid up, meaning a partly paid up share cannot be redeemed. If there is a preference share which is partly paid up, company has to make the further call, collect that call money, make that share fully paid up, only then it can go ahead with redemption of preference shares. So a partly paid up preference share cannot be redeemed. Very important thing to be noted is the share has to be fully paid up. And the next point is whenever shares are redeemed using internal funds, then CRR has to be created and shares can be redeemed either at par or at premium. Whenever the share is redeemed at premium, the company has to pay an amount which is more than the nominal value of the share. As a company, if I've collected 10 rupees on a share and on redemption, if I pay anything more than 10, that money what I pay more than 10 is what we call as premium on redemption of preference share. Such premium, whatever the company pays to the shareholder on redemption, should be adjusted against profit and loss account only. You might still come across some materials, some books which will say that company can pay premium and then adjust that premium against security premium. Let me clarify this point to you. It totally depends whether the company is in compliance of section 133 or company is not in compliance of section 133. 133 puts in the framework of accounting standards. If the company is covered under section 133, it follows accounting standards. Company can adjust the premium on redemption of preference shares only and only against profit and loss account. However, if the company doesn't comply with section 133, it doesn't follow accounting standards, such a company can adjust the premium on redemption of preference shares against security premium also. However, in all the problems that we'll be solving in our class or our examination, what we need to note is the company has to follow section 133 and comply with accounting standards. So, any premium paid on redemption of preference shares has to be adjusted against P&L account and nothing else. You might be wondering, sir, what if there is no sufficient balance in P&L account? If the company doesn't have sufficient balance in profit and loss account, and there is no profit that is earned before redemption in any other way, company cannot redeem preference shares at premium. I hope that point is clarified. So talking about the next part, I told it just a little while ago also. If in case the company redeems the preference shares using its internal funds, reserves or cash and bank balance which is existingly there in the organization, or by sale of any assets, in such a case, such money what is given to preference shareholders is company's profits, is company's reserves, and this will belong to all sorts of shareholders, equity as well as preference. When the company is doing good, if you give all this money to preference shareholders and redeem it, and later when there is no money, equity shareholders would cry. So company has to treat both equity and preference shareholders like two eyes to a human body. So what the company does is amount equal to nominal value of preference shares redeemed should be transferred to CRR. Amount equal to preference shares redeemed to the extent of nominal value has to be transferred to CRR, what we call as capital redemptionism. The funny side of the story is that one child is given money, the other child starts crying, what I told now. But the legal side of it is the company's capital will reduce on redemption of preference shares. I told this to you just a couple of minutes ago. The company's share capital will reduce on redemption of preference shares. However, as per the provisions of Companies Act, the capital of the company cannot reduce in any way other than by way of capital reduction, what is done as internal reconstruction. Let me repeat, company's capital can never reduce other than by way of capital reduction. Capital reduction under the process of internal reconstruction is the only way by which the capital can reduce. In any other means, if the capital reduces, that is by way of redemption of preference shares, what we're discussing in this video, or in the case of buyback of equity shares, on which also which will be coming out with another video very soon. In either of the cases, buyback of equity shares or redemption of preference shares, the capital will reduce, isn't it? So to the extent of nominal value of such shares redeemed or shares bought back, company has to create CRR, capital redemption reserve out of free reserves. Have a look at this. If redemption is out of the profits, then capital redemption reserve should be created to the extent of nominal value of shares redeemed. This capital redemption reserve can be used only and only for bonus issue, which is capitalization of reserves, which will again increase the capital, which will restore the capital to its original limits. So basically, company's capital can never ever decrease other than by way of capital reduction approved by the court under the scheme of internal reconstruction. I hope you all got this point. So this is the provisions of Companies Act. Remember, CRR needs to be created only and only if we are using internal funds, not if we are using external funds. External funds, by that I mean companies freshly issuing shares to raise money. If in case I am redeeming 1 lakh worth preference shares, to do this I am issuing 1 lakh worth equity shares. I issue 1 lakh worth equity shares. 1 lakh of cash is received. 1 lakh is paid to preferential holders. My capital is increasing by 1 lakh because of issue and it is decreasing by 1 lakh because of redemption. So on the whole, there is no reduction in capital. I don't have to create capital redemption reserve. However, if I sell my investment, plant and machinery, or use the existing cash balance from my business, balance sheet asset side, whatever asset is there is used to redeem the preference shares, capital will decrease at the cost of decreasing the asset, not at the cost of increasing one more capital. So is the reason why I told you that we need to create CRR only and only in the event of using internal funds and not external funds. Let's go forward and let's now try and understand as to what are the sources of money for the purpose of redemption. As I already mentioned, there are two sources. Number one is internal source. Number two is external source. Internal funds is existing cash and bank balance if the balance sheet is very cash rich, or the money raised by way of sale of assets like building or motor car, plant and machinery, or any investments. If we sell any of this and then raise funds, this is what we call as internal funds. And in the case the company uses internal funds, would have to create CR. Let me repeat that. And the next thing is company can use external funds. External funds is issue of shares. Even if you issue debentures, it would be something like internal funds. Okay. And as I mentioned, to comply with section 55 of Companies Act 2013, when the preference shares are redeemed using internal funds, we'd have to create CRR, Capital Redemption Reserve. Capital Redemption Reserve is created to the extent of nominal value of preference shares redeemed using internal funds, and this is created out of divisible profits. Profits which are readily available for distribution as dividend. Let me repeat, divisible profits or free reserves means profits which are readily available to distribute as dividend. In short, it is general reserve, profit and loss account, credit balance. Got it? Now, let's see with the points with regard to CRR. The points with regard to CRR is created to the extent of nominal value of preference shares redeemed using internal funds. I've already mentioned this 2 to 3 times in the present video all by itself. It is created out of divisible profits or free reserves, which means general reserve and P&L account. Then CRR can be used only to issue bonus shares to restore the capital to original limits, further ensuring that there is no decrease in the value of capital, because the capital can decrease only and only by way of capital reduction under the court, under the scheme approved by the court for the purpose of internal reconstruction. Got it? Then now let's talk about external funds. When we say external funds, we mean issue of shares. Now the question is how many shares to issue. This is a very tricky part. I want you to listen to this part very with great concentration and not skip this part. In fact, you might have to listen to this part once again the day before examination, because the questions which are little tricky in nature are under this topic. Some questions do tell us how many shares to issue. They say to redeem this, these investments are sold and this much of shares are issued. If the question is so kind and generous to us by telling how many shares are to be issued, it is all fine. But the question becomes very interesting when the question doesn't mention how many shares to be issued. The question says issue required number of shares, issue minimum number of shares is when it becomes all interesting. This is because the company is doing partly internal, partly external, or completely external. So in this case, all you need to do is you need to check what is a shortage. Is there shortage in profits or is there shortage in cash? If you say shortage in profits, I'll tell you. Now, whenever you redeem preference shares, you use the balance sheet asset side cash to pay. Now, let's say the preference shares are to be redeemed to the extent of 1 lakh. You have cash of 1 lakh. So you'll say, sir, sufficient money. Yeah, cash of 1 lakh will be used, capital will be redeemed. But when you redeem that preference shares using cash of 1 lakh, which is there in the balance sheet asset side, you have to create CRR. CRR should be created to the extent of nominal value of preference shares. In this case, it is 1 lakh. So you should have 1 lakh rupees available in general reserve and P&L account individually or together. What if there is only 80,000 available in CRR? Sorry, general reserve P&L account. Then you cannot create 1 lakh CRR. Then you can't use entire 1 lakh to redeem preferentials. What can you do? Only 80,000 is the value to which you can create CRR. Only 80,000 rupees is available internally for you to redeem preferentials. For the balance 20, you need to issue fresh equity shares. So this is what we call that the profits are insufficient. So what you do in this case is you would identify the nominal value of preference shares to be redeemed. Let me repeat, nominal value of preference shares to be redeemed. From this, you will deduct the reserves available, not the cash available of 1 lakh. Reserves available of 80,000 to create CRR you will deduct. So the deficiency in reserves is 20,000. When the deficiency in the reserves is 20,000, for such balance of reserves of 20,000, we are going to issue for such balance of reserve deficiency in reserves of 20, we would have to issue fresh equity shares. So when I have to pay 1 lakh rupees to my equity shareholder, 80,000 is from internal funds and 20,000 will be by fresh issue. You can again ask me, sir, why don't I use 1 lakh cash available? Because you have cash of 1 lakh to redeem preference shares, but you don't have 1 lakh reserves to create CR. So you use 80,000 of cash to redeem preference shares and 20,000 money is raised by fresh issue of equity shares. Because of which you have to create only 80,000 of CRR. To create 80,000 CRR, you have 80,000 figures. Got this? So what we do is nominal value of preference shares to be redeemed minus available amount of divisible profits. If you deduct, we'll get the deficiency. This is the extent to which you need to issue the new shares. This funds to be raised will be divided by paid up value per share, not nominal value, not the issue price. Note it, it is paid up value per share is what will divide it by to arrive at number of shares to be issued. Next, if the cash is insufficient, meaning I have 1 lakh rupees of preference shares to be redeemed, my cash balance is 80,000. I have reserves of 1 lakh to create CRR, but what needs to be given to preference shareholders is cash of 1 lakh. I don't have cash of 1 lakh. I have only 80,000 cash. So though I have 1 lakh to create CRR, I don't have 1 lakh cash to pay to preference shareholders. In this case, what we do is we again issue equity shares. When I'm issuing equity shares to raise the funds, I will not start with nominal value of preference shares. Remember this. I will not start with nominal value of preference shares to redeem. I will start with redemption value, that is including the premium if any. Including the premium if any. So when I start with this value, from this I deduct the cash that is already available with me. Meaning, let's say I want to redeem 1 lakh worth dividends, 1 lakh worth preference shares at 20% premium, summing up to 1 lakh 20. What I have in my balance sheet is only 80,000 rupees as cash. So I deduct 80 to arrive at the deficiency in cash and bank balance, that is 40,000. So the equity shares are to be issued to the extent of 40,000. Now when I want to compute how many shares are to be issued, I will divide the deficiency amount not by paid up value, not by nominal value, but it has to be divided by issue price per share. Number of shares to be issued will be determined by funds to be raised divided by issue price per share. So this is a very important part. What I would request you all to do is kindly pause the video at this moment and then please do write this down, because no material usually breaks this discussion of redemption of preference shares into this format, and you would learn this only in the problems. where you will see the problem and you will feel small jitters and you might get it wrong. Entire chapter of redemption of preference shares is easy except for this part. So please do pause this video at this point, note this entire thing down, and go back and then solve most intensive questions on redemption of preference shares using this sort of a working note. Trust me, you will come back and comment on this video saying that this video made redemption of preference shares easier than what it was to you before. Hoping to see that comment from your side. Now let's go forward. All the thing that I'm left with is to tell one simple point with regard to divisible profits and cash, and then I'll tell you the accounting entries. When we talk about divisible profits, what we're deducting here in the less part, this should be after adjusting the premium on redemption of preference shares, and if there is any loss on sale of investment or anything, adjust all of that and then take this. And here when we take cash balance, this is again after consideration of any sale proceeds received from the sale of assets or any other thing that's given, sale of investments or anything. Consider all the transactions before you deduct this to find the deficiency. Got it? Because the questions that you have in your material do have sale of investments and also have loss on redemption, that is premium on redemption of preferences. Got it? Let's quickly see the accounting part of preference shares redemption now. Like I mentioned previously, there are three ways in which the redemption is possible. One, out of profits. Two, out of fresh issue. Number three is combination of both, partly out of fresh issue and partly out of reserves. If I am redeeming my preference shares out of my reserves, at first I need to transfer my entire amount which is there in preference share capital account to preference share holder. When I do this, my preference share capital account will be debited, symbolizing decrease in my capital. And if there is any premium which I need to pay, again that is expense, I would debit that also, writing it as premium on redemption of preference shares, and all of it will be transferred or credited to preference share holder account, because preference share holder is my new liability that is getting created. Like I mentioned, preference share capital decreasing debit, premium on redemption, expense increasing credit, expense increasing debit, and preference share holder account credit because it is liability increasing. Then I would make the payment to that preference shareholder. So my liability towards preference shareholder will decrease. So I'll write preference shareholder account debit. I'll credit my bank account because this would reduce my bank balance, which is an asset. So liability decreasing debit and asset decreasing. And once I do this, there is this premium on redemption of preference shares. This has to be transferred to P&L account. So I'll write P&L account debit to premium on redemption of preference shares, transfer of expense, and the last entry will be creation of CRR, capital redemption reserve. This will be created from free reserves or distributable profits like general reserve and P&L. General reserve and P&L will reduce, so we will debit them, and credit will be given to capital redemption. Like I mentioned before, CRR will be created to the extent of nominal value of preference shares. In this case, to this extent, because it is completely use of internal funds. Next up, we need to note that preference share redemption account, what is debited here is credited here, and preference shareholder account, what is credited here is debited here. If that goes, what am I left with is preference share capital decreasing, so debit, bank balance decreasing, so credit. And if this goes to P&L, and then CRR will get created. One reserve is decreasing, the other reserve is increasing. Let us now see the next case, how to deal with redemption of preference shares by raising the money out of fresh issue. Let's get in there. Firstly, the company will issue fresh shares, because of which the bank balance will increase, so will debit bank account, and the share capital will also increase. Capital increasing will credit it to share capital. If there is premium on issue, write it to security premium account. This money will be used to redeem preference shares. So again, we'll pass the age-old entry, preference share capital account debit, premium account debit to preference shareholder. Preference share capital is decreasing, so debit. Premium on redemption is expense, so debit. And the credit will be given to preference shareholder because it is increasing liability. Then, using this money what is raised by issue of shares, we'll settle this preference shareholder liability. So we'll pass the journal entry, preference shareholder account debit to bank account. Here the payment is made, bank account is reducing, so bank balance reducing credit, preference shareholder liability is reducing, so debit. And once this is done, if there is any premium, it has to be transferred to P&L account. So I'll write the entry P&L to premium or redemption of preference shares. If in case there is premium here, we'll write this. If not, no. And here we are using external funds to redeem preference shares. So we don't have to create CRR. We don't have to create CRR. And here premium whatever is debited is credited here, that gets nullified. Preference shareholder account liability what is created here by crediting is debited here. Ultimately what we're left with is preference share capital is reducing and our bank balance is reducing. This bank balance has increased here and share capital has increased here. So total balance sheet mein, there is no decrease in the capital. So we don't have to create CRR. If there was decrease in the capital, to the extent the capital is decreasing, we would have created CRR, which will increase our capital at a later stage by way of bonus issue. Done, guys. By this we are successfully done with the second part, that is out of fresh issue also. Let's now see the third case, that is partly out of fresh issue and partly out of free use. Here you will firstly issue the shares for which the entry is bank to share capital. Then you would write the entry preference share capital debit premium debit to preference shareholder. Then you make the payment preference shareholder account debit to bank account. You will transfer the premium to P&L, writing P&L to premium on redemption of preference shares. And finally, to the extent preference shares are redeemed using internal funds, the funds other than by way of fresh issue, you will create CRR, a journal entry for which is divisible profits account debit to CRR. This is it. In few questions, they might even ask you to prepare a balance sheet extract after this specific redemption of preference shares. I hope you are well equipped with that. And this is it with regard to this video on redemption of preference shares. I hope you guys learned something new in this video and also had some fun. Remember, life is not a battle to be struggling, it's a game to be enjoyed. Till the time you're learning something, you're having fun. It's all good. The day you guys either stop learning something or stop having fun, trust me, you might start struggling because you might be in a battle. So the thumb rule to stay happy is pretty simple. It is to stay in the game. So for one last time, I have just one question for all of you. Are we in the game? I hope the answer is yes, we are in the game. If you want me to cover any other topic from your CA intermediate or any other syllabus, please do let me know in the comments to this video so that I can come out with a video on that topic to make it easy for you to clear your examination. See you in the next one. Till then, stay in the game.